will directly start from here. Okay. Uh, the first page is, this first half of the page is about, how money has conventionally developed in any economy. Uh, I think everybody knows this. We have studied this at some point of time, so I'll not waste any time on this. We can discuss about the barter system, yeah, and the double problem of double coincidence of wants. What I want you to focus and keep in mind during our lecture is these functions of money. What are the advantages of money system? So money is a medium of exchange. I mean, this is too obvious to even discuss. It's a unit of account and everything. The most important thing is that how money is an asset and how it is a store of value, and how money, the preference of money is known as liquidity. So what do we mean by liquidity here? Liquidity is the ease of access with which you are able to take out the money. So let us say if you have a 100 rupee note in your wallet, versus you have 100 rupees kept as saving kept in your savings bank account, which you need to take out using an ATM card. We are not assuming that we have the UPI and online payment systems right now. So obviously, and versus those 100 rupees kept in a fixed deposit. So it is very obvious that the money which is there in your wallet is the most liquid of all. Okay, so this demand for money, which we will study later using the graph, this demand for money is basically the demand for liquid form of money versus the the opportunity of keeping it as an investment, maybe as a fixed deposit or investing in some bonds. So basically, to vary the liquidity of the money. Okay. Uh, the next thing is, what is fiat money? Again, this is a basic introduction to how money works, and I think this is a bit too obvious. Uh, I'll just discuss what is fiat money. This is a money which is backed by a sovereign guarantee. So you see, if I have a 5 rupee coin, the amount of metal in that rupee coin, whether it is an alloy of copper and nickel, that amount of metal does not have the purchasing value or the market value worth rupees 5, but still there is a 5 printed on it, and when I offer it to a lender, to a seller, he'll give me the commodities worth rupees 5. Similarly, if I have a 500 rupee note, the actual worth of that note, the piece of paper, is nothing. But whenever I'm going to give that money to a person, let us say I go to a shop, that person cannot refuse me 500 rupees worth of goods. Uh, Why can he not refuse me? Because he and me, both of us, have confidence in that currency. Now, where does this confidence come from? This is shortly where how we are going to discuss the role of RBI. So on every currency note, you would see that there is a message written, and it is signed by the governor of RBI. It says that I'm promised to pay the bearer of this note a purchasing power worth rupees 500 or 100. It means that this money has been backed by a sovereign guarantee. In the case of India, it's the government of India, and RBI is obviously acting as an agent of the government here. So this is known as fiat money. Uh, as compared to other forms of money. For example, if you have a cryptocurrency which is not backed by any country, then the value of that currency is determined by the market forces, or by a mutual understanding. But uh, the money which is provided by RBI, it is known as fiat money because it has a sovereign guarantee. Okay, and not just in India but also outside. So this was a brief discussion about how money has evolved. Obviously, it can be a very big topic if discussed, but this is not something which is important from the exam point of view. One very important thing which we need to understand and which we will keep discussing is liquidity. Okay. Now coming to the main topic, which is RBI. This is a theoretical topic, and It has been discussed. I don't think in the book, but yes, in the PPT given by Ashok Thomas sir, this has been discussed. So I'll just briefly touch upon these points because these are important points. Okay, so what is RBI? Basically, it's the Central Bank of India. Okay, every country, almost every modern country today has a central bank, which acts as a main banker and main agent of money on behalf of the government or the ruler of that country. So similarly, in India, we have the RBI. Obviously, it is backed by the RBI Act 1934, and there are multiple acts like the Banking Regulation Act, but that's not something we have to consider. Now, what are the main functions of RBI? The first and foremost function is obviously issuing of currency notes. It's a different thing, just a fact, general knowledge fact that coins are issued by the government of India in their minting areas, and currency notes are issued by the RBI. But nevertheless, this purchasing power is enforced by the RBI. So obviously, that's the main job of RBI to issue the currency notes which are in circulation in the country. Okay, these notes become the legal tender, as we call them. Legal tender means that nobody in this country can refuse to actually settle their payment uh, via these notes. So if you are offering a currency note, an Indian currency note to someone in India, they cannot refuse it. On the other hand, if you offer them, let us say, payment via credit card or check, or something which does not have a immediate money value, it might be refused. People might refuse payment settlement via bitcoins or cryptocurrency, but they cannot refuse it legally via a legal tender. The second most important function of RBI is that it's a banker to the government. Now, as a banker to the government, RBI plays multiple roles. First, it is an advisor to the government, and by government I mean both central government and the state governments. So it will advise them where to invest the money, how to conduct the fiscal policies, and the government can at any point of time ask for advice via the RBI governor and deputy governors, and they would be tending their advice. The second thing is that RBI acts as the custodian of government money. So all the government securities and all the government dealings are taken care of by RBI, as and when it is required by the government. Of course, they can refuse also, but majorly it's the banker for government. It takes care of their assets and ensures that they are earning a good profit in the market. RBI is also a banker to other banks, so it is known as the bank of the banks. So all the commercial banks, and if you go through the PPT by Ashok sir, then in slide number 4, he has given a breakup of all the financial institutions in the country. So we have the commercial banks, like the retail banks we have, for example, PNB and SBI. Then we have some cooperative banks. We have non-banking financial companies. We have small payment banks like Paytm and you know Airtel Money. And we also have other financial bodies like housing, National Housing Board or something, and then we have SEBI and all those things, other regulatory bodies. But all this classification is not very much important from this exam point of view, because for the sake of this subject for this exam, we are only asked to focus on two things. The first is RBI as the central bank, and the second is other banks. So whenever we say other banks, we mean scheduled commercial banks. Okay. Why scheduled? Because they are mentioned in a schedule list which is released by the RBI from time to time. So that's the only reason. But you can, whenever I say scheduled commercial bank, I basically mean the banks. Okay. The next function is that RBI is the guarantor of fiat money, as we just saw in the above example, that there is a uh, statement which is declared on each note that if you provide this money to RBI or to any other settlement, then they are liable to pay that amount, that purchasing power to you. RBI is also known as the lender of last resort. This is again a part of banker to the other banks, because if nobody is willing to pay money to any bank, and they are on the verge of bankruptcy, then RBI will eventually step in and bail out the other banks. So it is also known as the lender when nobody is lending the other banks. Okay. Then again, RBI has credit control functions, which we famously know as the monetary policy. And this monetary policy is currently administered through a monetary policy committee. So it's a six-membered committee. It has its own, constitution and preamble. So we are not interested in that. We just know that there is a six-member committee, which is legally required to meet at least twice in a year, twice in 6 months, I believe, twice in a 6 months or twice in a quarter, to discuss the monetary policy. And this is the committee which releases the policy rate, which we will discuss later in this session, the repo rate, as we call it. So this credit control function is done through monetary policy. RBI ensures that there is no excess liquidity and there is no dearth of liquidity in the economy, and it has its own supervisory function. So RBI is not just a banker to the other banks, it also has control over the other banks. This is the body which issues licenses to other banks. It can cancel the licenses to other banks, like we recently saw RBI cancelled the licenses for Paytm if they do not comply with the rules which are mentioned or laid down by RBI from time to time. It also has what we call as qualitative, uh, you know, tool of monetary policy. So the number tools which we see, like policy rate, repo rate, CRR, SLR, they're known as quantitative tools. But it also has qualitative tools, which we know as the power of moral suasion. So, this is like Gyan Dena. So, RBI governor will often in his public conferences and meetings, he will try to address the fellow bankers and tell them that do this, do that, try to lend more to MSME sector, try to reduce your CRR because we are reducing the policy rate and all those things. Then again, exchange rate management is also a function of the RBI for the foreign exchange. And sterilization is basically protecting the economy against external shocks via, regulating the forex. So all these things we will see one by one. This was the theoretical part, and now we will move to some more interesting part of RBI. Okay, how does RBI generate money? How is money supplied in the economy, and how it is demanded by the various players in the economy? And by players, we are majorly concerned in this subject with two main players. The first is individuals, the citizens of this country, the public as we call them, and the commercial banks. Okay. All right. So this is a sample balance sheet of RBI. Okay. Like any other balance sheet, the assets and liabilities have to match. And what can be the assets? And this balance sheet can vary slightly, from SIRS PPT to other things which you see. But more or less, if you are asked in the exam, you can just memorize a few of these things and try to produce it. So, what are the assets of RBI? Of course, the first asset is the gold of the country. Okay. Uh, this is a very important topic, and we will see how all these assets and liabilities, they actually correspond to what we know as the monetary base of the country. So please pay some attention here. So the gold which is deposited in RBI's treasury or with the government, it is an asset of RBI. Okay, foreign exchange, which it is earning, the forex reserves as we call them, is an asset to RBI. Okay, government securities. Now, what is security? Uh, I think this word comes up a bit too often. Words like security, bonds, debentures, treasury bills, uh, commercial papers, bills of exchange. Uh, you can just put them in a one single definition. If I have to explain it in a very layman term, security or bond, as we call it is a piece of paper which is backed by guarantee, not just ordinary paper. So security is a piece of paper. If you have this paper, then in some future date, somebody who is mentioned on that paper is liable to pay you some money. As simple as that. So if I have a security which is provided by you, then on a future date which is mentioned on that paper and according to the deal which is mentioned there, you are liable to pay me some money, which is why I am holding this security. So whenever RBI is giving a loan to the government has to issue some security to it. Let us say RBI gives 100 crores of loan to the government of India. So government has to issue that much worth of securities to the RBI, and they become asset of RBI because they are claimable by RBI. They can be claimed. So we have a very common misconception that whenever there is shortage of money with the government, it will just ask RBI to print more currency. And I hope we now are all now clear that it does not happen like that. It cannot happen like that. As they say, कि पैसा पेड़ पे नहीं उगता. So पैसा सच में पेड़ पे नहीं उगता. Whenever government has to ask RBI to print currency, it has to produce some liability of the government, which becomes an asset to the RBI. Okay, so these government securities which government has deposited with RBI become an asset. And again, similarly, these loans which are extended by RBI to the commercial bank, we saw that it is a banker to the government, a banker to the other banks. So it also helps them in times of crisis. It can RBI understands that it's not every day. The banks can have problems of shortages of liquidity, temporary mismatches in the balance sheet, which have to be tallied to avoid a bigger crisis. So it loans those things to the other banks, and they become an asset to the RBI. Okay. Now, one thing which you can just memorize, or you can just understand right now, if a government is offering us security to you, okay, it is known as government security or G6. It is also known as treasury bill, especially if central government is lending it to you. So T bills or treasury bills or G6 or government securities, all of these are just simply securities. And if a commercial bank or if a private company is giving these securities, then they are known as bonds or debentures, depending on like US has a slightly different definition of debentures, but more or less for any general purpose of understanding, if you come across these terms, you can understand that they mean one and the same thing. It's just the names differ. Okay. Now, what are the liabilities of RBI against these assets? Any piece of currency note on this in this country, in this land, or even outside, which has the sign of RBI governor mentioning that मैं धारक को 100 रुपए देने का वचन देता हूँ और I promise to pay the bearer 100 rupees worth of purchasing power, it is a liability of the government because the public, the currency holder can at any point of time produce that note to RBI. Basically, it does not go to, we do not go to RBI to purchase stuff, but if you actually go to the RBI office, you are given 100 rupees worth of purchasing power. Okay, so all this currency is basically a liability of RBI because it is required to give that much of purchasing power to the public. Now, this currency is held in two ways. One is the currency which is held by the public. And you would see that everywhere in this topic, the concept of liquidity is coming up. This currency which is held by public, or whether it is held in the vault cash simply means your bank lockers. Okay, so whatever money you put in your banks, it is also a part of currency. SCB, again, Scheduled Commercial Bank. Then deposits of commercial banks with RBI. So RBI, we know that it mandates commercial banks to park some of its money with itself, which is known as CRR, cash reserve ratio. We will discuss it in detail. Now, because banks have parked it with the RBI, it means that it is a liability of RBI. It has to provide them to bank whenever required. If the bank goes into bank run, then this CRR is going to be the main tool of RBI to help this bank in crisis. And again, the treasury deposits of government of India or state governments also. So with state government, we also have one more thing, which is known as SDLCs, state development loans. I'm not exactly able to recall the abbreviation, but it is something like SDLC. So basically, that's State Government Development Loans or something. Okay. So all of these T-bills, again, treasury is a form of security. It is a form of bond. It is deposited with, the government has deposited it with RBI. So this becomes the liability of RBI. Okay. I'm just linking them. That doesn't mean that they're exactly equal or something, but yeah, this is how the securities are exchanged between the government and the RBI. Okay. Now, coming to uh, the main part of it, why we are discussing this balance sheet of RBI, you would see that this entire liability of RBI, what is this? This is the entire money which RBI has put up into the system, right? Whether it is in the form of currency, the most liquid asset, or it is in the form of some commercial bank deposits, or it is in the form of treasuries. There are other things as well, which obviously this is not a very comprehensive list. But what is this? Basically, this is the total liabilities of the monetary authority of the country. Monetary authority means RBI. Okay. So this is the entire money which RBI will have to produce whenever it is asked for. And hence, this is known as monetary base. Okay. In terms of measure of money, which is a part of our syllabus, we call it as M0. Okay. M0 is known as monetary base or high powered money. Why high powered money? Because this is the entire base of money which is actually in circulation in the entire economy. Okay. We do not have to confuse this with the GDP of the country, which is the total output in a given year. As against that, this is the entire money base, entire money which is there in the economy. Okay. When demonetization happens, it is this monetary base which is being, a major part of which is being replaced with new legal tenders. Okay. So basically, the paper is changing, but the monetary base is this. Okay. So what do we mean by this? Basically, this monetary base is what we call as the money supply, right? So whenever we saw that this money supply graph was a straight line horizontal to the y-axis. Okay, this is a graph which Ashok sir has taught us, and the question was why this M3 graph is always a straight line. Why it does not vary with the interest rate which is varying here. Okay, so the reason is because at a given point of time, the supply of money is constant. Okay, it is not possible for RBI or for anyone in this economy to change the supply of money overnight. Okay, so at the macro level, in a short term perspective, this M naught or this monetary base or this high powered money, which is the total liability of RBI, the same thing, it has many names, it has many definitions. Okay, and it is a stock concept, which means that it is always measured at a particular point of time. It is not a flow concept. So we had studied flow and stock in financial accounting, so this is a stock concept. So this high powered money or monetary base is also known as uh, the supply of money. Okay, as against this we have the demand for money. So we will see what is exactly the demand for money shortly, but this is the supply of money. Okay, now this is something which RBI is giving us, M naught. Okay, but whenever we are talking about money supply in the economy, we have multiple ways to measure it. And these, now you would ask, why multiple ways to measure it? Why not just call it one single thing, such as M naught or M0? It is because as we discuss the concept of liquidity, so at various points of time and to calculate the various aggregates of macroeconomy, the various indicators and various variables, we have to use multiple measures of money supply. So we broadly have four measures of money supply. I'm not counting M naught here because M naught though is there already. It is the base. It is from where you are actually calculating money. Now, uh, as a RBI governor or as a government, I am interested in knowing what percentage of my money is being kept in liquid assets versus which percentage is kept in short-term commitments and which percentage is invested in long-term commitments. There could be very long-term, credit lines of, let us say, 10 or 15 years. That's not going to solve my immediate monetary crisis, which happens today. So, which is why I need to understand about the various measures of money supply. So, I've tried to put this up in a diagrammatic form so that it is easier to understand. In the PPT, which is given by Sir, I think it's slide number 14. Yeah, so in slide number 14, you have this in the form of theory. So you can just study it along with this diagram. It is much easier to understand. So we have four different measures of money supply, M1, M2, M3, and M4. Again, they are in the decreasing order of liquidity, which means that M1 can be claimed almost immediately. It is the most liquid asset. And M4 is the most least liquid asset. Okay, least liquid of money. Okay. Now, M1 and M2 are also known as narrow money. M3 and M4 are also known as broad money. Reason remains the same. It is in decreasing order of liquidity. Okay. We'll check about why I have put up this pink font here. So we will first understand what is M1, M2, M3, and M4. Okay. Now, in an economy, we are assuming that there are three main players. Okay. First is the public. Okay. The second is a bank, and the third is a post office. Okay. Uh, we assume that the money which is kept in banks is more liquid than the money which is kept in a post office. Reason being, post office is not the main place we are actually going to store your money. Okay, its main job is to transit the courier across the country and abroad. But it also gives us some saving instruments. Like there are some RD, some term deposits, some small saving schemes, monthly income schemes, and all those things. Okay, so we are assuming that the money which is there with the public. So we are talking about this part of the liabilities of RBI, which is known as currency, and it is a liquid asset. High liquidity. Liquidity is high. Okay. Obviously we have commercial banks, K deposit, we have treasury deposits, we have securities and all of those things, but they cannot be claimed readily. Yeah, they have some terms and conditions. Yeah, let us say if the time period is for 10 years, you cannot claim it before 10 years, at least not without a penalty. Okay, so we are assuming that this liquid money is stored in various forms. Okay, so if I am keeping this money in my pocket, it is known as currency. Okay, currency with the public. If I'm keeping this money in a bank I can put my money in two different ways. The first is known as demand deposits. Okay, DD. Let me just write it up somewhere. Okay, DD is demand deposits and TD is time deposits. I hope we must have studied this, irrespective of our background, somewhere, sometime down the line. Demand deposit is that money which does not have a time period to it. So if I'm putting my money directly in a savings account or I'm putting it up in a flexi kind of a deposit, or this money which can be readily drawn. So I go to a bank today and I write a check on myself. I'm able to withdraw certain amount of money. I go to the ATM. I put in my debit card and I'm able to withdraw that money. I can claim some credit on this money using my credit card. All of this money is known as demand deposit because it can be taken up on demand. It can be withdrawn at demand. But let us say you have your money in a fixed deposit or a term deposit of 5 years, and you go today and you say that I need this money. Then bank will say no, you cannot have this money because it is in a commitment. And if you insist, then you have to pay a penalty for it. Okay. Similarly, for a PPF scheme, public provident fund, there is a lock-in period of 15 years. So these two deposits make up what we know as net demand and time liabilities of a bank. Okay, I'll write it up here. Net demand and time liabilities. Now, why liabilities? Yeah, because this is your money which is being kept in the bank. Whenever you want it, bank has to, you can claim it from the bank. So hence it is a liability of the bank in their balance sheet. Of course, it's an asset for you in your balance sheet. Okay. Uh, Demand and time. And then this is known as net. Why net? Because banks also keep other banks' deposits with them. They also keep RBI's deposit with them. They also put their deposit in other banks. Okay, so these banks have accounts within each other to settle transactions. Let us say you are doing an RTGS from PNB to HDFC. So there is a settlement which is done at a regular interval. Okay, whether it is 24 hours or every 15 days or something. So this net means only the money which is belonging to the public, to the general public, and not the interbank money. Okay, so it is obvious that a demand deposit is more liquid than a time deposit. I'm sorry, it's getting messy. I'm trying to write as less as I can because I've already created the notes, but this is something which we need to uh, be aware of. So demand deposit is more liquid than a time deposit. Okay. Now, using this concept, we are going to study about the various measures of money. So what is M1? M1 is the currency which is kept in my hand and the money which is kept in the bank as a demand deposit, not as a time deposit. Now it is very obvious that this is the most liquid money. Okay. So hence M1 is the most liquid asset. Currency in my hand, I can readily spend it at any point of time. And these demand deposits, they can be claimed by me earlier using debit cards and ATMs. These days now, I can just GPay or I can UPI it, and the money which is deducted is a part of these demand deposits. Okay. What is M2? If I include the demand deposits which I have put up in post office as well, in addition to my M1 money, which is currency with me and demand deposit in a bank, this becomes M2. Now this is slightly less liquid because it is not every day that you are going to a post office to claim your money. It is usually kept with an investment perspective. Okay. What is M3? M3 is less liquid. Of course, we are moving towards more rigid money, less liquid money. So this is the money which is in currency circulation in my pocket and the entirety of banks. So post office is not involved here. So everything with bank, whether it is a demand or time deposit, it's an M3. And because you know we cannot just call M2 as one of the most common measures of money supply, because term deposit is also a thing. After all, we keep very small fraction of our money as directly in the savings bank. Mostly it is in the form of FDs and RDs and all those PPF and all those things. So hence this M3 is known as the most common measure of money supply. Okay, whenever RBI is publishing any report and it mentions something we call as aggregate monetary resources, so RBI is basically referring to M3. Okay, so it is the most commonly measured. Okay, it is like the optimum balance, neither too liquid nor too rigid, and it is lying somewhere in between, and it contains almost the entire count of money, for aggregate purposes for macroeconomic policies. And what is M4? You include all of this, entire currency, entire bank deposits, entire post office. Of course, this does not include, please keep in mind, this does not include national saving certificates, Kisan Vikas Patra, Indra Vikas Patra, and all those things which are long-term policies, saving instruments, long-term saving instruments which we have with post offices. We do not include them in M4. Okay, so these are the four different measures of money supply. Okay, uh, very important part of our topic. We have done this, and of course, we have also done this thing. Supply of money, this is constant at the macro level and it is a vertical axis. So I think it's hardly 2 minutes left. I'll just summarize what we are. 2 minutes left for this recording. So I'll just summarize what all is left and then we will re-record it. The next part is demand for money. I will not touch upon it a lot right now. First, we will go to monetary policy after understanding few topics here, and then we will come back to this demand for money because we need to understand how monetary policy is affecting this demand for money. Okay. I think time is working very slow, so I'll just quickly touch upon this. Now we have already seen what is the supply of money. This is the RBI side of the equation where RBI is supplying money into the economy. What is the demand for money? Which player comes up here? These are the common people who have a demand for money, and of course the banks. Okay, so now demand for money can be considered in two different ways. First is if my motive is to transact, I need this money for transaction. It is known as transaction motive. And the second, demand for money, whenever I'm saying demand for money, I'm talking about liquid money, demand for liquid money. So I'm also using speculation. Okay. If I think कि बैंक में interest नहीं मिल रहा है, so I will keep the money in my pocket rather than putting it in the bank. So this is a speculation which I'm doing. It is not my transaction motive. So these are the two motives for demanding my money. And the speculative motive is also known as liquidity preference model. It is mentioned in slide 17 of Ashok sir's PPT. We will stop here.